Hello, good evening everyone. So in this short video, I just thought of sharing my opinion on unit linked insurance policies. So most of my clients in recent times, they are asking about this unit linked insurance policies. There are some surveys also regarding this. So whether it is the right time to purchase this unit linked insurance policies. So I thought of just sharing my views. So as always repeated, my views always will be basics. I don't want to make the things complicated. Keep the things very simple as possible. Greatest things in the world are simplest ones. I always believe that. So therefore, I don't want to make this concept very complicated. Understand the fundamentals. Understand the fundamentals is enough. You don't need to read the hundreds of pages of documents given by various insurance policies. You don't need to read those lengthy documents. Just understand the basics. Based on that, choose a decision. Okay, right. So first of all, unit linked insurance policy. The basic structure is it is a combination of purchasing mutual funds and also purchasing insurance policy. So normally people used to do separately. So sometimes we'll take an insurance policy, somewhere you'll take the mutual fund, you'll invest in the mutual fund. Now the combination of mutual funds and taking insurance is nothing but unit linked insurance policy. Unit linked insurance policy. In traditional policies, conventional policies, if we pay premium to the insurance company has the freedom to decide where to put our money. So based on the investment returns, they will give bonus. Based on the investment returns, they will give bonus. And some assured they will give. But in case of ULIPs, if the unit holder survives, there is no question of sum assured. Whatever is the investment value that you will get. Okay, in case of conventional policies, they will give the sum assured, even if the policy holder survives. But here that guarantee is not there. Guaranteed minimum amount is not there. That is the basic point here. So basically, it is a combination of rather than going for mutual funds separately and insurance policies separately, we are combining both at a single place. Okay, right. So the advantages of ULIPs is that point. So you have the potential to generate more maturity value. So the drawback, it is frankly speaking, this unit linked insurance policy is nothing but customized insurance policy. Simply speaking, forgot about it as an investment product. Think of it as a customized investment policy, customized insurance policy. Normally when we pay premium to the insurance company decides to invest somewhere else. So at that time, insurance company may be more conservative. Insurance company may be more conservative in its investments. But here in this insurance policy, you can take your own decision. Whether if you want, you can take more conservative decision, or if you want, you can go for a high risk opinion. You have that flexibility. So normally insurance companies are very conservative. That may be the reason you may not get much bonus. If at all the policy holders are getting much bonus, most of the people might not have turned to the equity funds. So why the people are going to the stock market? Because the insurance policy maturity amount, some assured or bonus may be less. That is the important reason. If I purchase an insurance policy and I pay 10 lakhs premium over a period of 10 years and I'm guaranteed 40 lakhs, then why I'll go for the equity funds? The reason is that insurance bonus will be less. That's a fundamental point, because the insurance company may go for conservative investments. That is first point. Because suddenly if they get claims, they should have the liquidity to pay. That is the reason maybe they will keep money idle. Maybe they will keep everybody money idle. I am also a policy holder, you are also a policy holder. Your money will be kept idle and my money also will be kept idle. That is the problem with the traditional insurance policies. Here, unit linked insurance policies, I can take a risky decision, even though the other policy holders are not taking a risky decision. In case of conventional policies, you have to go along with your policy holders. That is a standardized decision. In case of conventional policy, the decision is a standardized decision. Here it is a customized decision. I can take my own decision. I need not go along with my other policy holder colleagues. Okay, that is the basic point. Therefore, because of your flexibility, because of your own decision making, it has the potential to generate more maturity value. Potential. I'm not guaranteed. There is a chances. Okay, right. Next, drawbacks. Fundamental drawback of this unit linked insurance policy is dual charges. If you invest in mutual funds, they will charge fund management fees, fund management charges. And if you go for insurance policies, insurance company also will take some charges. Here you are combining both. You have to pay both charges. That means the important point here is that unless until you are very risky investor, you are ready to take risky investments, risky decision, this policy is of no use for you. Unless until if you choose the risky investment, this policy is of no use, because your return should compensate two charges. Your returns should compensate fund management charges and also insurance coverage charges. Since you have to cover two types of charges, you need to get more returns. So after coming to the ULIP policy, if you want to be very conservative, it's of no use. Go for the conventional policy. At least you can save the charges. The moment you come to the ULIP, you have to be prepared to take more risk. Like equity investments, you have to prepare to take more risk. So you cannot be conservative. If you go for ULIP and if you are still conservative, it's of no use. You cannot cover up these two charges. Be clear. Enter the ULIP if you are very risky investor. If you are ready to take more risk. After entering the ULIP and taking more conservative fund, it's of no use. You cannot cover these two charges. Very important. Okay. After selecting ULIP, you have to take the risky investments only. Okay. Next. So our opinion is that, so if you have already not taken an insurance policy, then take the ULIP. If you have already taken the insurance policy, don't take the ULIP as an alternative to the investment in stock market. If we want both. We want both. One is life protection, risk coverage. Another one is investment. We want both. If at all we have already taken the insurance policy, don't again take the ULIP. Don't again take the ULIP. Invest on your own equity funds. Directly invest in the equity stock market or real estate, small pieces of land, whether it may be normal usable land or agricultural land, or here or there, you can invest in the gold. Go for the other investments. If you have already taken the insurance policy, go for other investments. Don't take this ULIP. Treat ULIP as an alternative to the insurance, not as an alternative to the mutual fund. Very wrong decision. Treating this as an alternative to the mutual fund is a very wrong decision. You have to take it as an alternative to the insurance. Okay, right. That is the important point. So if you treat it as an alternative to the insurance, the point here is whatever the value you get, that is a bonus for you. If the policy holder survives, whatever he gets, that is a bonus for him. That is a bonus for him because he thought it is only for risk coverage. Therefore, whatever he gets, it's a surplus for him. Therefore, no disappointment, no regretting. But if you take it as an investment perspective, if you put money as an investment perspective, you may get disappointed. There is a lot more chance of getting disappointed. Be careful. Therefore, take it as an alternative to the insurance. Therefore, our predominant focus is risk coverage. That's it. I don't get anything from this. Take it as an alternative to the term insurance. So normally people will take term insurance predominantly only for risk coverage without any expectations of returns. You go for this policy also like that. If at all you get anything, that is a bonus. You will not regret. Okay. Therefore, my opinion is that you have to treat it as an alternative to the insurance. And selection of funds is most important. So different funds, I have selected 3 funds. I'll give you. Look at this. This is one of the HDFC fund. They are giving the options. So that the policy document may be 10 pages or 20 pages, but the primary point you have to look at this is the funds option. What are the options they are giving? Okay. So if you go to this HDFC policy, so you can select this fund, blue chip fund. Don't never ever select multi-cap spectrum. Never select multi-cap spectrum, small cap, mid cap or risky. Small cap or mid cap or risky. Select only blue chip investment, safe side. Okay. Right. So blue chip fund, exposure to large cap equities and equity related instruments. So if at all you take this HDFC ULIP, my suggestion is that you can go for this fund. You can go for this blue chip fund. Okay. And or else if you want little bit lesser risk, you can go for this secure advantage fund where you'll get higher interest rate. Okay. May not be much capital growth potential. At least you'll get the higher interest rate. So these two are my advice. If at all you go for this HDFC ULIP, you can select these funds. Normally, in case of insurance, they will decide. But here you have a choice to decide where to put your money. So therefore, my advice is go for this blue chip fund or for this secured advantage fund. So this is for the HDFC. They are giving these options. If you go for the ICICI ULIP, so they have given multiple options here also. ICICI have given more options than HDFC, etc. You can go for this opportunities fund. If you go for this ICICI ULIP, you can go for this opportunity fund. So they have selected carefully investment related companies, consumption related companies and human capital leverage industries. Now the fund which focus on consumption related is the fund for the next 10 years, or you can take for the next 30 years, the consumption related. Indian economy will be driven by more by consumption rather than by investment. If not 30 years, if the 30 years is more exaggerated, at least take for the next 10 years. Or at least take for the next 5 years, Indian economy will be driven by consumption based, not investment based. So therefore, this is a good point. This is a good based investment, good strategy to invest in consumption oriented investments. And the next point, blue chip always is safe. There is no second thought about that. If you are going for blue chip, there is no second thought about that. Or you can go for this fund also, India Growth Fund, or this fund. 3 funds I can give. One is opportunities fund. Another one is this thing blue chip fund, another one is India growth fund. These three you can select. This is my opinion. My opinion, it may be customized based on the investor position, the funds will change. So in general, I'm saying, so this is Advelas. So Advelas ULIP policy, here also you can go for this equity large cap fund. And so one more fund they have given equity blue chip fund. If you observe, there is no much difference. They have given the different names, but the policy is same. So here also 60-40, 60 equity and 40 debt high risk, and it is also 60 equity and 40 debt high risk. There is no change in that. But what exactly is the difference? That you need to speak with the fund manager. So one thing I can tell you is that the sales executive, whoever is speaking with you regarding this ULIP policy, so better ask them, request them that, sir, we want to speak with your fund manager, because the sales executive may not be having much knowledge about these funds. So if you have some questions, don't compromise. Ask the sales executive that you want to speak with his superior. You want to speak with his fund manager, who will clarify better than the normal sales executive. Okay. So therefore, this is very important. Rather than people are normally looking for the charges. So first my focus should be on the return. If my return is freezed, then I can, to maximize that return, I can reduce the cost. Reducing the cost is to maximize the return. So if you focus only reducing the cost without returns, of no use. Focusing only cost without any returns is of no use. Therefore, don't directly go for the charges. Which company is charging less? First select whether the return potential is there. After selecting the funds which has more return potential, then the second stage of filtering comes for the charges. So therefore, whenever you go for the ULIPs, directly go and choose these funds. What are the fund opportunities are there? Okay, different companies. So these are the three I have seen. If at all you come across any ULIP which is investing in the foreign company shares, foreign companies equity shares, that is also best. Or a company which is investing in the real estate, that is also best. So these three, they are not giving any kind of potential. Okay, any kind of investment in foreign securities. That is the point. Okay, so the important point is selection of funds. The important point is selection of funds. Right. So next, timing is important. Normally equity funds are invested. Normally ULIP is selected when the market has a full growth potential, high growth potential. But if you ask me, sir, is it the right time to invest in the ULIP? No. My answer is no. It is not the right time to invest in the ULIP. Wait for 3 months or wait for 6 months. So wait for 6 months. After 6 months, maybe in the next from the next January, you will come to know some basic understanding about the economy, how the world economy will turn out. You'll get some clarity. According to me, it is not the right time to go for the ULIPs. Wait for 3 months or 6 months, then you'll get some clarity over the world economic position. Based on that, you can take the decision. Okay, thank you one and all.